Welcome to the Dividend Talk podcast, episode 153. Irregular Dividend Compounders with special guest, the Kleine Kapitalist. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavor. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJ. I'm surrounded by a double Dutch sandwich today. How are you?
Oh, you're in the middle.
Yes,
So
yes.
how are you?
I'm good. That used to be what was it? Double Irish and a Dutch sandwich was an old way for companies to avoid tax, if I remember. So
Yeah.
maybe there's something there.
I definitely think so, and they probably saved a lot of dividends via that way in this dividend talk, so it fits really well here.
So for our listeners, we have the Kleine Kapitalist here. I'm excited. It's the second time he's on the show, but the first time I'm here when he is joining us. The Kleine Kapitalist, welcome to Dividend Talk.
Yeah, thanks for having me. It was a while, like 2 years ago, and I'm happy to be here. Thanks.
Yeah, it's for those that don't follow, you have an awesome blog, but also on Twitter, you always post these amazing charts. But you are the master of hidden gems, and I'm actually looking forward to some of these companies that we're going to talk about later on, because you always pull one or two companies that I've either never heard of or that are just really interesting. So I'm looking forward to today's show.
Yes, me too.
So we usually start with the news of the week. This time there is something here on Ahold, but when I click the link, it's in Dutch. So I'm going to need one of you guys to talk me through what's in the news this week.
Yeah, what is the news that triggered me was that they also posted about their data-related business. So what they do is that they also earn money by selling data used for advertising sales, and they envisage to be like a 1 billion earnings in 2025. So this is quite big for Ahold Delhaize, and I was really triggered by this news.
So yeah, it's really a different kind of source of income, right? Because what you're saying is they're effectively selling their space on their homepage to advertise. It's pretty much what Amazon is doing. And what blows my mind is that this can just literally turn into a $1 billion or 1 billion euro business just by selling web space, using and leveraging the Ahold website. And I believe this applies to both the US and the Netherlands, right? So
exactly. And also when you see groceries working with margins of like 4%, I was looking for new revenue sources, and this is a great one.
Yeah, and the irony is that it is probably more profitable than the whole bol.com business unit under it. And if you think about it, because it also comes with laser thin margins. So it's almost like the Amazon model, right? Where you create a lot of page views almost by just being a wholesaler. You sell everything, but in the end, you don't earn the money on that. But then you earn the money on, I don't know, advertising, or you have a secondary product behind it where you turn a cost center into a profit center, what they did with the cloud. It's quite amazing how these, let's say like that, what digitalization can bring to these kinds of traditional grocery companies in this case. Well, I'm long Ahold. So for me, this is only good news because it can allow us to pay growing dividends, more share buybacks, and actually really good to hear this.
Yeah, it's actually very interesting. And look, it's worked for Amazon, so why not other companies like Ahold take a little piece of the pie and use that money to, as you say, distribute dividends and buy back shares for us guys. But no, that's interesting. That's very interesting news for Ahold. Okay, so this week's show is around irregular dividend compounders, and it's something that we don't often talk about. So, the Kleine Kapitalist, maybe you might give us an overview. What is an irregular dividend compounder for you? What defines it?
Yeah, irregular is based on the dividend aristocrats, so who always grow the dividends annually. But sometimes you have companies who have a cut or keep it flat and only 1 year, or is it for longer? So this is difficult. When I started my journey, I had this principle, like when they cut the dividend, I would sell. This happened too much for me, for my portfolio. I think recently we have this with Castellum and Intel and VF Corp, for example. But also, for example, with THULE. And the next year, I saw that they increased the dividend with a higher amount than the year before they cut it. So this means that actually their dividend streak continues only with like a small dip. And this is a very distinct from companies who really cut it and will never get to the amount anytime soon. So I see a distinct between the dividend aristocrats, the dividend cutters, and one with dividend streaks which are interrupted or irregular. So this was the topic I would like to discuss with you.
And the interesting part about that is that in 2020, of course, with COVID, so what we saw there is that otherwise healthy companies were much more conservative because the world was closed down. It was February, March, exactly at the moment where everyone was announcing their dividends. Lots of uncertainty if we will ever get behind after this zombie apocalypse, right? So it was also a special time where there were a lot of dividend cutters. And what you're saying is like, maybe we should treat that as a one-off. That should not really happen because generally these companies are very healthy. Is that kind of what defines for you an irregular dividend compounder in that way?
Exactly. So this is also a way to prevent selling stocks which are actually good. So this is what I've learned. So I'm now for 5 years. Yeah, this is my 5th year in dividend growth investing, and this is the nice thing. You always learn. Yeah. And this is one of the things. Previously, I would just sell the stock right away, but now I learned to look deeper and see what is the real reason why they cut the dividend. Especially with Corona, there was a lot of governmental influence, especially in France. It was more easy, but sometimes you have to dig deeper, and then you find that the company is actually still very good.
Yeah, and I said, how do you deal then? Because that's always the question that I have in my mind with these companies. How do you deal then with the fact that that they are maybe more subject, or there's more risk in your portfolio that they might cut the dividend? Because specifically when the market is under stress, there's a crisis, you might need the dividend income even the most, because at that time you cannot just maybe step in easily and into an Uber and earn some extra cash. So how do you look at that point of view?
Yeah, of course, your portfolio should be balanced. You cannot have many of those stocks. I see myself as more looking for a bit more risk. But when I would reach more my fire level, I might change my portfolio somewhat. So if I need to rely on the dividends, maybe it would alter it. But still, if you have trust in the company, yeah, it's also like my tax refund, which I just received. It's also fluctuating. I cannot count on it. So this is just part of life.
And how much percentage of your portfolio do you then allocate to these kinds of irregular dividend compounders, or maybe not even allocate in a way that there's a plan behind it, but how much is naturally of those in your portfolio versus more the traditional ones that you can count on?
Oh, good question. Well, I think I have like 10 or 20% in those kind of stocks, but it might happen. It can happen, of course, with many stocks, but I think it is also better than companies who keep their dividend streak at all cost. Yeah, you see, I started a bit worry about companies like Medtronic. We had the 3M, all those well, basic stocks that everybody had 5 years ago. They start to have some. I don't know the proper word for this, but they.
Yeah, I know what you mean. What they specifically Medtronic is a really interesting case because I know on social media this stock was quite popular when it hit the low 80s again because people look probably at historic prices. But the free cash flow has been hardly growing over the last 5-6 years. The new CEO is not able to turn the ship around. So it looks like they're at a certain maturity stage where they need to find new markets because it seems to be hard for them to grow in the current market. So there's no free cash flow growth. But at the same time, such companies have built buying back shares a lot and leveraging up to provide shareholder return. Yeah,
Exactly.
and now with the increasing interest rate environment, this becomes even more cumbersome because their high payout ratio, I believe around 70 or 80%, becomes more under stress because there's less cash flow left after the interest payments, right? And this, of course, a trick if you're committed so much to the dividend that you let your balance sheet deteriorate and you lose flexibility when you're under stress. And I think, yeah, there's definitely a point to that. But this is also where I always say, like, we shouldn't be buy and hold investors, but buy, hold, and how is it? Adjust or evaluate investors. And that's why I keep Medtronic as a relatively small position exactly for that reason, because I don't see a growth catalyst at the moment. I know the CEO speaks about a dozen, but I don't see it turn into reality, so I'm a bit skeptical there. But it's also not yet under stress enough for me to sell it. So I think an analyst would call it a hold, right? A hold position as such.
Yeah, that's exactly the same. It could look really attractive, but I don't buy and I don't sell. The very long term, I still have faith in Medtronic, just because aging population.
Yeah. Good.
I'm quite interested in you spoke earlier that you no longer sell if it's a dividend cut. Before you would have sold, you no longer sell. You now dig a little bit deeper to see the real reason. What exactly do you look for now? What kind of metrics or what do you look for specifically not to sell the company?
Well, the why, when they just don't have enough money to pay the dividend, that's more easy to sell. But when they have and make another choice, for example, they make the choice to keep more money for long-term investments, like some companies really express. Well, then I'm happy to keep it as long as their prospects are good. And
you have some examples of companies like that?
Well, I had done this with THULE, and the other example is my most recent buy. Company is called Alberts. It's a Dutch company, and in the Dutch dividend community, I think it is familiar, although it is not in the AEX, the primary index. But still, it is has a long tradition in dividend growth and sustainable earnings growth. So I think this is a good example.
Okay, so I've never heard of Alberts before. I think it's ticker symbol AALB. So maybe you might just tell us a little bit about the company, what makes them a good company, and why they should be maybe considered as an irregular dividend compounder.
Yeah, well, first an introduction for this company. I think many listeners won't know this company. It was founded in 1975 and started only with 4 employees and 400,000 euros of guilders of debt. And this in the industrial space. they went public in 1987, and just when you look at their earnings, they just grow. And it has the name of an holding company because they acquired so many small companies. But the last decade, they changed. They changed and focused from many divisions into 4 end markets. And this is where I was triggered, because those end markets, they call it mission critical technologies. These are eco-friendly buildings. Then you have to think about expansion vessels, like the more in the heating and water equipment in buildings. It is in semicon efficiency. They deliver precision materials for example, with ASML. They are really in a strong partnership, and they are in sustainable transportation. They also make coatings, sealers, waxes on metal plates. So they are also in the eco-friendly buildings, but not in isolation, but in energy saving systems. And they have like 3 big trends. The first one would be urbanization. This is clear. We all want comfortable and healthy buildings. The other one will be the climate change, scarcity for water, energy, and materials. And the Internet of Things, the Industry 4.0 thing, which I described extensively in my Schneider Electric post, which all are beneficial for this company. And when then I look at their the business model, how they work, that's really about innovation, high margins. They preferred above high earnings, strong partnership. They have really unique products, pricing power, and also very attractive valuation. So this is a clear buy for me.
What I like, right, when you study a little bit their website, investor relation website as well, right, they talk about the Albert's playbook.
Exactly.
Which is really, really speaking out. And I love it when you go to an investor's website, investor relation website, when they straight away tell you, okay, this is the kind of company we are. And they write their relentless pursuit of excellence. Okay, of course, there's some advertising behind it or branding behind it. But it's really for them like strong free cash flow, disciplined capital allocation, portfolio optimization. Now, then you can be saying, like, okay, it sounds nice, but we know that not many companies do this, right? Many companies, if you go to the investor relations website, you hear only blah, 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 how much they are in ESG and how great they are, but you don't see this concrete information. And then straight away afterwards, they show you the numbers. So they made €1.40 in earnings per share in 2012, 2022, €3.37. So they've been growing on a compounded growth rate, probably as about 10%, right, in earnings over a decade. Dividend per share grew from 35 cents to €1.11. And what I really like is this return on incremental capital employed, as they call it. Something similar to the return on invested capital numbers of 19% almost. And this shows you why Alberts definitely also deserves the term compounder here, right? Because often when you talk about high quality stocks, these are the figures that you're looking for, I would say.
Exactly. And what I also like is that they really just say it. It's like almost US kind of style. And you have also, for example, NN Group, which is targeted by other companies because they are so muted in their communication. And this is just no nonsense. They just say what they do. And I think this is a strength.
It's a bit like Texas Instruments, right? The only thing that what again would be an issue for me is their dividend policy, because they want to pay out about 30% of their earnings, right? So we always say, like, for the dividend to grow, the earnings need to grow. Yeah. But when earnings don't really grow for a few years, like maybe what we said about Medtronics, you would like to still see the dividend income coming. Yeah, how do you
Yeah.
look at that with a company then like Albert's? What if it will have a few years of, at the top of the S curve where they flatten out and not a lot of growth is happening there?
Now, that could happen. For example, their biggest segment is the sustainable buildings, almost 60%, and contractors can go bankrupt. We have this whole slowdown in real estate projects. So this is the biggest risk that I see. But I can see through it because I see the other three divisions and they grow like hell. And I see the trends, I see what they do, I see they invest, I see they have partnerships, I see that they can grow with those kind of companies like ASML, Applied, ASME. So this is I've got trust that this company will grow in earnings like they do, not for 10 years, but for 45 years with 10%. That is their track record.
Yeah. And can you maybe explain a little bit more then about the other business units? Because indeed, if 60% of one business unit is subject to the real estate market, that sounds like high risk. And we come of a 15-year like non-stop growth almost, right? For some of the real estate, if you take it from the bottom of 2009, let's say. So yeah, I'm curious to the other business divisions.
Yeah, so I already mentioned the semicon efficiency. This is highly precision materials and fluids, controls, measurements. This requires high skills and experienced teams. So they have really strong, I call it partnerships with those customers. It's not easy to get there. So this is really looking very good. Then they have the industrial niches. I already talked about the coatings, the sealers, and the waxes. For example, this is a bit technical about metal plates. But what you need to know is that they have a really unique proposition. They spent a lot on innovation and go really for high margins and can keep up with those innovation spend. So and when you look at their valuation, it really don't look like an innovation company. So I think it's a hidden gem.
So can you maybe explain a little bit more then about the dividend profile at the moment? So what is their dividend yield at the moment?
It is 2.8 or 2.9%, if I am correct. So as you mentioned, the policy is a 30% payout of the net income. And this is also the reason why they cut the dividend during Corona. And they really stated that they want to commit to what they say. So they say 30%, then they pay 30%. And they believe that the money that they save by not paying the dividend will help all shareholders eventually for the long term. So this is really a long-term play company. And I like it.
Yeah. And if I'm correct, it's now trading at 40 euros and a bit of change, which gives it a price to earnings ratio of 14. And we are talking here about a company that has kind of a return on investment to capital of 18%. So from that point of view, I agree with you. If you look only at those numbers and you don't take, let's say, next year's expectations or the year after expectation into account, this looks just really solid. So what are your expectations for the upcoming 2 years? You mentioned already a little bit, the real estate market, which is slowing down. Then semiconductors is also having some issues. On the other end, Intel announced to, for instance, invest in a factory in Poland. Is this then where Aalberts will be supporting, or should we look in other areas of the semiconductor space? Because semiconductors having heavy capital investments at the moment, right? Here.
Exactly. But this is a company which has a solid financial, healthy balance sheet. So they really can grow with those big semiconductor players. And they also can acquire companies that they need to grow. This is also, I think, important. In terms of risk, besides the contractors, I think the biggest risk is that I do not evaluate their pricing power correctly. So now they can pass on because last quarter they grow autonomously like with 6%, despite the slowdown in the biggest segment. This is a strong, proof of their pricing power. But of course, this has a limit. And when do we know when the limit has been reached and people look for competitors? This is a very difficult one, especially when you are with a more high innovative, high margin businesses.
I suppose there is another company out there I'd like to mention, probably would fit into this category, which would be Louis Vuitton, LVMH. I'm sure our listeners will know more. We talk about this company as high quality on this show quite a bit. But if you look at their dividend history, they have actually cut their dividend back in 2018, I believe. So is this a company that you would consider a irregular dividend compounder?
Yeah, I think in France, this is just a governmental issue. When you look at Louis Vuitton, there's such a strong brand and products. I went in a train with one of the buyers of Ahold Delhaize. They buy from Louis Vuitton and others, and he mentioned about the champagne market. They control 40% of the champagne market, which is already growing nicely. And he elaborated on how they do it, and I thought, wow, this company is so well run. It's on all segments, and you really see it in the numbers. So this is for me close to an FSL stock.
But you mentioned that it was governmental. Would that not concern you if the government is getting involved? Is there a risk that they could continue to get involved and force them to depress their dividends?
Yeah, it's a matter of balance. So I have a couple of French stocks, and then I know the government they can make them not pay the dividend or not increase them. But on the other hand, French companies are quite protected by government. If they are in deep shit, they get more support than German companies, for example, because they are more patriotic.
Really quickly, I want to still round up on Aalberts. So Aalberts, great balance sheet. I checked it out. Debt to equity also 40%. Interest coverage ratio of 20%. So to me, if you look at these numbers and you would ignore the dividend policy, you would definitely argue they have a safe dividend because the payout ratio is low. Dividend growth overall is also really high. The prospects are pretty good generally if you take it from the long term. So it all looks good. It's just that the dividend policy is not supporting dividend growth necessarily an uninterrupted streak. So I think it really, really well defines an irregular dividend compounder. So thanks for that. Ticker we have also in the show notes, right, for people that want to look it up. If you have any article about it, also let us know. We'll put also the link in the description. But also, you mentioned also THULE today. And THULE is for me really interesting because THULE is this company that creates all these bike carriers and such, and roof racks for people going massively on holiday, right? You see them all over the place. Go to any campsite in Europe and you see these THULE boxes on the car. I also did one time like a little bit of a deep dive into it, and it's quite an important, quite a great brand with actually a strong moat if you look at it from a brand power point of view, right? It's easy to copy these boxes, but it's the same like with soda. Yeah, everyone can kind of create a cola drink, but still people continue to buy Coca-Cola, and that's THULE for me. Now, explain a little bit more about this one, because I think many people were disappointed with their dividend cut, specifically after they refreshed and announced their strategy at the time.
Yeah, but the reason is exactly the same. They also don't have an explicit progressive dividend policy, also a percentage, and that's what they do. So this is exactly the same as for Alberts, actually. Yeah, and about the company, yeah, I have the same. I do go to campsites, and I was amazed. Like the percentage of THULE stuff is insane, and they're not cheap. So how do they manage that? It's brand power, but the products are also really of good quality. And for my portfolio, it is like the play on holiday. I don't know if it's a team, but
the vacation play.
Yeah, it is a different name in like.
But what you're effectively saying is like more people in Europe will go on vacation by car, going on car holidays and such, instead of taking an airplane or something like that. And this is a growing market in general, right? With all the campsites and everything around Europe, and you expect sales growth as a result of that.
I expect so, yeah.
Yeah.
Of course, the Corona played a big deal. People fast forwarded their purchases, and well, they did not really manage their stocks, their inventories that well, like many other retailers, for example, as well. But now it looks more clear. But still, this is not I would say not a core holding, but it's a nice play on the holiday team.
And what I also noticed at the time, I think the dividend from 2019, which they had to pay out in 2020, got cut, but I believe they then added it with the dividend the year after, right? Is that correct?
Exactly. That is why I also think this is a regular dividend compounder. So when you really look through it, you can still see their dividend is growing every year, although not every year.
Yeah, and I think also a nice example. And if you look at 2022, right, THULE at the top in January 2022 was trading for 528 Swedish crowns because it listed on the Swedish stock exchange, and then it crashed all the way to 202 Swedish crowns in October last year, and now it recovered to 300. It has a PE ratio of around 30 and a dividend yield of 3%. How do you look currently at the valuation of THULE, and what are you doing with this company? Are you buying more as the hold?
No, of course, I regret not buying at 200. I had a buy order at 200. Not. But no, I don't think it is now undervalued, actually. Maybe a bit, but market forecast is difficult.
Yeah.
So I would not buy and would not sell.
Yeah. Well, thanks. So we discussed now actually two stocks that we call irregular dividend compounders, right? And we also know about LVMH, and there are a few others. And I think it's a really interesting topic, specifically from European stock point of view, because the dividend policies look different. And my takeaway is from your story is like, look at high quality companies, most and for all, and if they are able to grow their cash flow and earnings, and they do pay a dividend, and they want to reward shareholders with dividends, then in the end it should grow over time, right? And that's what you're saying, and that's why it probably deserves the term compounder here.
Exactly.
Yeah, it's a bit too how is it? Gives me a bit too much shivers to define my whole portfolio like that. But you did inspire me that maybe in some cases I could close one eye from time to time if it's really worth it, but I would never make it a large part of my portfolio because my intention is to live off dividends, of course, in let's say 5-6 years from now. And if this would be impacting my dividend income by 5 to 10%, that's a lot, specifically if I would first go for a slim fire instead of a fat fire here. So what I mean with this is if I go on the exact expense dividend cut over point, then I cannot afford any dividend cut. And then it would be a bit too much risk for my liking. But other than that, it really opens up for more high quality companies, I would say. How about you, Derek?
Yeah, I'm quite similar. There are some really quality companies there, but like you, my plan is to live off dividends, and I like repeatable and regular. Irregular it can be good as you said, but I like predictability. So I tend not to I would tend not to go with companies like THULE or Albert's because I know the quality's there, but I can't predict what my dividend income will be, and that would be a problem.
Yeah, but from the other side, I feel also a bit like a hypocrite because I have Rio Tinto and BHP in my portfolio. I would not consider them high quality compared to Louis Vuitton, as an example. But they're on the high yield kind of play.
Yes. For me, you're getting paid for that risk because you're getting a higher yield. With, for example, THULE, your yield is around 3%. That's way too low for that type of risk.
Yeah. So. Yeah. Well, really interesting, the Kleine Kapitalist, and thanks also for bringing this different perspective to the podcast. And I know you have several of them, so we'll definitely also put the link to your blog in the podcast. But you're also a popular person. You were here in episode 55, and I remember your recommendation to for instance, consider Avast, the antivirus. I believe they got purchased and acquired in the meanwhile. But I remember after that, like after you came on the show, like literally a month later, the stock pulled off into the stratosphere, and also it was growing the dividends nicely. So yeah, let's see a little bit what the listeners have to say and what they would like to ask you here. So let's go for the first question, and it's from Koen de Bruin on Facebook, and he wants to know more about BESI. So he said the company was by far his largest position in the portfolio. He bought some shares when they were at 43 euro. Now at around 100 euro, he sold 33% of the shares, and he will keep the rest for dividend growth in the future. He loves this company effectively. Great catalysts because of hybrid bonding. I don't know what it means, but he does, I think, and a good balance sheet. But he feels it's a bit expensive. So he's just curious to what you're thinking about the stock at the moment.
Yeah, I also wrote an extensive post about BESI. It is a bigger holding for me. I think he did it really well. I also noticed that around 100 euros, and whoa, it has doubled in just a small time frame. But this company, has grown for so many years. Like I made one comparison that they when you bought it, like I don't know, 10 years ago, you could buy it for the price the dividend they pay now. I mean, this is insane. Wow. This is really Irregular 2.0. When you look at their fluctuations, it goes up and down, but eventually when you look at what you get rewarded as a shareholder, this is really insane.
I can see them looking at the share price chart, and in 2014 it was trading at 4 euro, and now it's at 100 euro. It just shows how it pulled off. I mean, this is like the compounding curve in extreme, as you're saying, indeed. So you own some, right?
Yeah, I own, and this is on the back end of chip machine equipment. And this is also a moat. I think hybrid bonding, they have at least 2 years technological advantage, and they just have a unique position. This is what I like also about ASML, of course. This is not ASML, but also a moat. And Well, I'm happy with their large dividend distribution. It's not really the same like the special dividends. I think you also talked about it, like with AGCO, American Financial Group, CME Group, Landstar. I have a lot of them also with the special dividends. It's also irregular. But this is well, a nice addition to my semi chain, because I have a lot of semiconductor plays, and I will not sell it.
Nice one. So I hope, Koen, that you how is it that you can do something with this answer. But it sounds like a great stock. The next question is from Jacob, and he's now heavily in insurance stocks like Allianz, Legal & General, and ASR. And effectively, it's a question to both of you. What do you feel like is the largest percentage in the accumulation phase that you would like to own of a specific sector?
Yeah, I think we spoke about this on the last episode. We touched on this kind of subject, and you mentioned we're in the accumulation phase, and it kind of ebbs and flows. You will go over your allocation, but once you reach it, you just hold on to it forever. For me, I have this same problem, Jacob. I would say that I have a total, I think I've like total 5% per position total that I want, and once I reach that, I'll stop. So I'll keep accumulating these companies until they reach that 5%, and then at that point I will stop buying them and look in other directions.
Yeah, I have similar. For me, it's like depending on the tier that I place them in.
Yeah.
How about you, the Kleine Kapitalist? Do you have any limits in the accumulation phase of the size of a position, or related, let's say, to the sector?
No, not really. I must admit that all companies that I added for sector diversification, all are worse. Like that didn't help me. So I would more concentrate on what I know and I'm familiar with. And well, when it happens to be like 20% in semiconductor, I would be happy with it.
Okay. Nice one.
Tiago has asked about ASML to the Kleine Kapitalist. So he's saying, with the shift in interest rates and the need for more profits now, have you changed your investment philosophy towards higher yielding, lower growth businesses, or are you still on the ASML train?
I would say I'm still on the ASML train. That's easy. Yeah, we have this discussion about low yield, high dividend growth for a long time, but I still I'm in the low yield, high growth camp, I would say. And interest rates, I think they will be high for a while, but it don't influence my decisions yet.
Okay, we'll move on to the question from El Cuba, and he's asking, which EU dividend aristocrats are for you the best ones for the long term?
For me, it would be L'Oréal, Louis Vuitton, ASML, Linde, Diageo, ASSA-B, Novo Nordisk, Wolters Kluwer, Essilor, Luxottica, Schneider. There are so many.
If you could only pick one of them with a gun on your head and you need to hold it for 20 years, which one would it?
That would be between L'Oréal and ASML. I would go ASML.
ASML. And why not L'Oréal?
It's also good, but I think ASML will grow
more.
Yeah.
Okay.
Interesting. Dakota Fred has asked us, would you consider to diversify your portfolio and start adding some bank deposits as their interest is growing?
Come on. Dakota, Fred, or let's say Fred. Fred, I will send a link to you about from our shop with merchandise, and we have a t-shirt there, or a hoodie, which mentions bankers are wankers. And it comes from a deep-rooted feeling that I have, and it's in my no-buy zone. I see banks as pure speculation. I mean, it's kind of as a leveraged product because they are highly leveraged, and you see what happens when there's a bank run or anything. So for me, banks in general, over the long run, are not investable if you are serious about dividend growth. And take this with a pinch of salt, how I'm saying it, because there's some, how you say it, some allergy behind it towards them. But I think over my dead body that I will ever invest in a real bank.
I was laughing when I seen that question come in. So you handled it quite well, I have to say. I was expecting more of a rant, but well done. And then we might move on then to the last question, which I skipped from Martin and the Kleine Kapitalist. That is, do you have any stocks that are on your watch list, or what are you buying right now?
Yeah, so on my watch list is Ecolab. I also own this stock already, and I have a post about it. And this is more in the what I call the razor blade business, but then for hospitals. And yeah, I think this is a company which will do good on the long term. Not big growth, but decent growth, sustainable growth. So I think it is currently undervalued. So this is why it's on my watch list.
And then can you explain a little bit, like what you mentioned, the razor blades for hospitals? So do they shave people there in the hospital? Or what do they sell? What products do they sell?
It's like disinfectant, for example, like the machines. It's a lot of equipment actually, but they just have the dispenser. They provide it, and then you have these consumables that you buy. And what I really like about Ecolab is the fragmented market. So they are already the market leader, but only with 8% market share. So they have a lot of potential to acquire other companies and grow. They have the scale, so they are in the best position in this market. So this is why I think this company will do well.
So for our listeners, the ticker symbol is ECL, but I'm quite curious, when you say they're undervalued, are you looking at free cash flow? How are you valuing them, or what are they? What metrics do you use to value them?
Yeah, most of the times free cash flow yield and return on capital employed kind of metrics. So, but also like I look at fundamentals mostly.
Yeah.
So, what is the chance that they succeed in their growth plans? And for this company, I don't see that much risk. So this is why I think it's a good investment.
Well, then I have just one question that probably many listeners have in their mind by now. Is like, where do you get your stock inspiration from?
That's a good question. So the first source is real life. So I think with THULE is an example, but Alberts also. For example, my home is energy neutral. It has those heating pump and floor heating, really balanced, like recouping of heat. Of course, solar panels and stuff, and this kind of thing. It's so comfortable, and it's also low cost for me. And then you start looking how is this made, and what are the companies who build this kind of stuff, and then you end up we do it more for like bigger companies.
But this is really at the heart. This is the Peter Lynch approach, right?
Oh.
Just look around you. Just look around you. Observe the world around you. Look where the trends are. Look at what, for instance, your other half is buying, and what are they talking about, and then check if those companies are healthy companies, and whether they have it in them to continue to grow, right? And that's effectively what you're saying. If you're so much aware and asking yourself, like the chair that I'm sitting on in this room, how did it came to life? And I know that many more people in the world would love to sit in a house like I have, energy neutral, because there's a climate thing going on. That's really the Peter Lynch philosophy, as I took it away from the One Up in Wall Street book, which is really interesting.
Yeah, exactly. But this is only one source, of course. This is well, no, this is the first, the primary source. I think it's also the thing when you get attached to a company, like you really feel what they do and how it plays in your life. But otherwise, this is also reading. It's in the community, which I mean, and also with Twitter. So there are many more sources. But I think the real life experience is the most important one.
Nice. It bodes well with invest in what you know. We always say that on the show, invest in what you know, and what better way than what you experience in real life, because then you really understand what a company does. I mean, how it impacts you, how it impacts the people around you, and I think it's a really good method. But it must be tiring if you're looking around every single day. I wonder who makes this. Are they a good company? Are they a good company?
No, and it's also sometimes when you just pass along. I am sitting in a train, past the Ecolab building, and I also have this with Air Products and Linde, industrial gases. It's not for consumers, right?
Yeah.
But then I see it, and then I just think, why is this brand name here? And figuring it out, and then you sometimes see these great businesses. But of course, time is limited. Sometimes it's also nice to sit in a train and not look at all those numbers.
Good. Thank you so much, the Kleine Kapitalist. For me, it's always a pleasure to talk with you. You inspire me so much, and I really also like this thinking of investing in irregular dividend compounders. Like Derek and I said, it's probably not the first thing we think about, but you did inspire me to maybe have some more thoughts about that over the week and see if I should need to do something with this. I definitely hope that this is interesting also for our listeners that are maybe also not having a pure dividend growth strategy, but would love still to receive lots of dividends in the future, but can take, like you say, a little bit more risk. Yeah, and it was your second time on the podcast, so thank you for that. I hope we may also see you a third time, maybe in a year from now again, to see how those irregular dividend compounders are doing, and to hear some more of those hidden gems that you're continue to discover, I would say. So thank you so much for being here.
Yeah, sure. It was a great pleasure to be here. So thanks for the invitation, and I hope to see you next year.
Good. And, for all the people that were listening, we'll put the details to follow the Kleine Kapitalist also in the description of this podcast. So the link to his blog, the link to his Twitter profile, and so that you have an easy way to follow him. Thank you, guys, and see you next time.
See you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.